So I've been extremely busy this winter working on a very large project which will hopefully be ready for release in about 2 months, sometime in late May, early June. But as part of that project, I'm developing several web applications developed for small forest landowners. Namely, among those are going to be a forest growth modeling application, a forest land investment analysis tool, and right now I'm actually working with a Ukrainian software development firm to develop an online GIS mapping application tailored to small landowners. Now that last one I'm most excited for, but it also comes with the most uncertainties. But one of the applications that's 100% developed right now is the financial analysis tool. And I'm super happy with it. It's incredibly robust, and I think it's going to be the best tool available because of its multi-dimensional approach. Now, of course, that means it is a bit complicated. So I've been working on some user manuals and video tutorials to help people use it. But as I've been doing this, I've realized that the problem is you have to have a base level understanding of risk. Because when you're looking at investments that span multiple decades, it's inherently a comparative analysis. How does this investment compare to others? And to be able to compare investments accurately, they have to have roughly the same level of risk, because risk by definition is uncertain. So you have to assume that they'll succeed and fail at roughly the same rates. Now, of course, that's all a bit theoretical because it's a bit like Schrodinger's cat. Either it's going to work or it isn't. But even so, you kind of have to be comparing things with the same probabilities. So to give an obvious example of this, let's say you had the choice between putting your money in a 4% yielding bank account, which actually those exist these days, or you could put it in, the latest cryptocurrency phase. Well, it's easy to say, well, look, over the last year, this coin has gotten 20%, so let's put it here instead. Well, the failure rate for the bank account is going to be very low. Not exactly zero over the long term, but very low. With the cryptocurrency, it's almost expected to fail over a fairly short period of time. That's the point. Now, we can all accept that at face value, that's a very obvious principle. The problem is when we're looking at things that are a bit more nuanced or things where the risk is obscured, we tend to forget about it. We tend to group things together and compare things that shouldn't be grouped together and compared. And this is incredibly important to understand when looking at Timberland, because Timberland is astoundingly, amazingly unique. It's not, risk-free, but it's incredibly unique in the risks it has. And to me, it's actually one of my favorite things about the asset itself is just how different the risks are. So in this video, I really wanted to give an in-depth look over the risks of Timberland so I could go back and reference it later because it's incredibly important to understand, especially if you're serious about your land ownership. All right, so first let's talk about risk, kind of what it is and how it's usually modeled. So if you ask most people, even financially literate people, they'll usually say something along the lines of more risk, more reward. And that assumes that there's some sort of correlation between the risk of an asset and the potential payout. But actually that's not true at all. There's almost zero correlation. In fact, I'd make the argument that the assets and the bets with the biggest payoff actually have the smallest amount of risk. And there are investments that have the smallest payout that have the biggest amount of risk. All risk is a function between probability and magnitude. The probability that a negative event will occur and the magnitude of that negative event. So the easiest way to visualize this is with a very familiar shape, the bell curve. And just for simplicity, we'll say that the y-axis represents the frequency of events and the x-axis represents the rate of return. So in this instance, the frequency is representative of probability and the rate of return is representative of magnitude. So let's just look at a theoretical investment and say the curve looks something like this. So it's a standard distribution, and the vast majority of the time and the average, you're going to get about a 5% rate of return. Now, a relatively small percent of the time, you're going to get returns as large as 15% annually. And another fairly small percent of the time, you're going to get negative 5% annually. But overall, it averages out at 5%. So we could pretty reasonably say that this investment pays 5% annual returns. Now, this, of course, is a very simplistic model, but I would argue this is actually how risk is modeled most of the time. Even in the world of high finance, They add extra steps, but ultimately this is kind of the risk analysis they're doing. The problem is this view of risk never plays itself out in reality, almost never, and that is because of something called fat tails. So each end of this bell curve is known as a tail, and of course they are the highest magnitude but lowest probability events. So they would be, in this case, your positive 15 and your negative 5. What if there existed extremely impactful events that were also extremely improbable? We're talking so improbable that they were essentially binary. They either happened or they wouldn't. So let's take this same standard distribution and modify it a little. Let's say that instead of being capped at negative 5, it was possible to have a year with negative 80%, but it was extremely improbable, and we don't exactly know what the exact probability is. This one event is so impactful that it can actually affect the mean returns to the negative territory. So if we add in that negative 80% that could happen once every 50, once every 100 years, who knows? It could average out your returns to, -1, -2, even worse than that. And if you look at most assets, this is exactly what happens. Most assets have fat tails. So first, let's look at probably the most obvious example, and that would be the stock market. Now, at least prior to 2020, we could all agree that the stock market is capable of crashing. But even so, I think we've kind of lost sight of exactly how frequent and how impactful this can be. So if you watch enough, financial media, if you follow some YouTube guys like Graham Stephan or something like that, they usually say something like, over the long run, the market always goes up. And there's very good reason for people saying that. It's objectively true over the past 50 years or so. The problem is, this is not necessarily the case. And most people alive today, the sort of recessions and crashes they're used to are like the dot-com bubble or 2008, where, maybe your portfolio is negative for, 3 years, and then it comes roaring back. But this is actually historically anomalous. And I would argue that massive market downturns are the historical norm when it comes to stocks. And there are several examples of this, both in the United States and the world. So if, for example, we were to look at the Dow Jones Industrial Average, between 1915 and 1980, the stock market essentially had no appreciation aside from dividends on an inflation-adjusted basis. So for the better part of a century, the only returns you were actually getting from the stock market were dividends paid by individual stocks, and those tended to be fairly small. I think at the time they averaged around 3%. And then of course 1980 was the beginning of the greatest bull run in world history that we're still currently in. But even in Japan famously had a massive stock market bubble and collapse in 1980, and only in the last few weeks did they exceed previous highs from the 1980s. So for the majority of the last half century, the stock market has done nothing in Japan. In light of this, I would very much argue that equities are an asset that are dominated by highly impactful, improbable events. And importantly, those two functions with the Japanese and American stock market were just the result of normal economic forces, recessions and so on. But it can also be subject to wars, pandemics, and basically any other negative risk you can imagine. Now let's look at bonds. Now historically, bonds have been seen as a kind of, safe investment class. But that's uniquely an American phenomenon. Over the course of the 20th century, bonds performed worse than the stock market. Nations had a higher failure rate than businesses. So to illustrate my point, let's look at one nation, Germany. If you were to buy a German bond in 1916, you lost a lot of money. If you bought another German bond in 1922, you lost money again. If you then bought a German bond in 1935, you lost money. You're also making some questionable decisions. And by the 1970s, you couldn't even buy a bond in East Germany. And there are similar stories to be had in Austria-Hungary, the Ottoman Empire, Chile, Russia, China, Poland. The list goes on. And of course, there are many events that can cause a bond to fail. It's usually inflation or a default of some sort. So if we were to take a look back at our fat tail model, and we just looked at the rate of inflation, and of course, the currency is the other side of a bond. So if you were to look at the average inflation rate of a currency, you have events every once in a while, like in Germany or in Hungary, hyperinflation. So you have currencies inflating at absurd levels. We're talking, sometimes 100% a day, 1,000%, just absurd levels. So if we were to apply this to our bell curve model and look at the probability and impact of an event, currencies are defined by massive inflationary events. They're improbable, to be sure, but their impact is so great and the inflation rate is so high that you could probably average out the inflation rate of a currency to over 100%. Now, don't quote me on that because you'd actually have to do a lot of math to figure that out, and I'm not going to do that. So far we have the two most popular asset classes, equities and bonds, and they're defined by these improbable events. So let's get back to forestry before I lose most of you. First, let's remember something. You can break forest land into two fundamental values. Bare land value, which is just the real estate value of the land without any other values on it, and the timber value, the value of the standing timber on the land. That's important. We'll get back to that later. So first, let's look at the obvious risk, a market downturn. And let's go really bad. Let's say it's a Great Depression level event. What would happen to your asset if you had a Great Depression level deflationary event? Obviously, that would hurt quite a bit. You would lose a fair amount of value. But I want to recall something that happened in 2008. And I know my audience is mostly rural, so I know a lot of you are going to have similar memories. Do you remember in 2008, at the start of that recession, how many houses were sitting empty? And over the years that recession lasted, or at least the broader downturn, many of those houses sat empty for years and they began to decay. And eventually, what ended up happening to a lot of those properties is they were condemned. That's because something like a house, it takes a lot of upkeep. And if it's not being used, it's just kind of a money sink. And there comes a point when it doesn't make sense to keep putting money into a property. And so a lot of these places, especially in harder hit areas, the Rust Belt and places like that, they were just left to decay. And a similar thing happened in the 1930s with farmland. So the land I have is actually old farmland that, in my estimation, was abandoned in the Great Depression. And so you had a massive downturn in the price of crops, and a lot of the smaller fields just weren't profitable anymore, so they were abandoned. And what happened after a few years of sitting fallow? Well, those fields became forests. So in most real estate assets, what happens is if something isn't producing, you lose it. It goes to zero. It loses its productive value for that purpose. But something happens with a forest if there's a large market downturn and it isn't, producing, there's no harvest going on for quite some time. It's growing wood. Your forest has two modes of production: appreciation and forest growth. One is economic, and that would be appreciation. The other is completely biological. It has no connection to the economy whatsoever, and that is the actual growth of the trees. So maybe your land would sit for 20 years and the market was so bad that you couldn't produce a thing. Well, after those 20 years were over and the market started to tick up just a little bit, all of that growth that was put on over the last 20 years would retroactively gain in value, right? So it was still producing all that time, and when the market does kick back up, all that growth is retroactively more valuable. That is an extremely impactful process. And again, this isn't a theory. I actually have a great example of this that it just blows my mind. So where I used to work in Maine is around what is called the Allagash Wilderness Waterway. And in the middle of the Allagash Wilderness Waterway, which is surrounded by absolutely nothing but forest, it's something like 70 miles from the nearest McDonald's, just out in the middle of nowhere, there's something really fascinating. There are two steam locomotives. We call these ghost trains. Now, it might seem odd in 2024 to see two steam locomotives out in the middle of absolutely nowhere, but as you would imagine, these used to have an extremely important purpose. They were used to move logs from more of the interior of the wood down to the lakes where they were then floated down to mills. So they were an extremely important piece of industrial infrastructure. Then the Great Depression hit. What happened to those steam locomotives? Well, they were shut down, and originally it was temporary, but the years went on and the market remained down, and there was never a fire in those engines again. But you know what is all around those trains? Productive forest land that is still being harvested. It is still producing lumber to build our homes. And the owner of that timberland, except for the state of Maine because they own some around there too, but the owner of the majority of land around that area is still owned by the same family that owned it when those trains were operational. The landowner survived. The industrial operator did not. That is crucial. So those are the economic risks, but there are of course more risks to forest, like the biological risks, the insect outbreaks. Certainly that is a very big concern. And again, where I'm from in northern Maine, we kind of have a history with very detrimental insect outbreaks, namely with the spruce budworm. So the spruce budworm actually targets balsam fir, which is a very commercially important species. And their outbreaks last about 15 years, last occurring from, if I have my dates right here, 1970 to 1985. And yeah, that had a detrimental impact, especially because the paper industry was so big. Paper industry loved balsam fir, so it was extremely impactful for sure. But here's the thing about insect outbreaks. So the spruce budworm is supposed to occur about every 40 years. So since I started my career in forestry, which would have been about 2014, I've been hearing about the spruce budworm. We're supposed to get another outbreak any year now, but it just doesn't happen. And it's been 10 years. I think it's safe to say it's probably not going to happen because the condition of the forest has just changed tremendously. And it's my opinion that it's probably just not as conducive to a large-scale outbreak. Now, certainly there have been some localized increases in populations and some excitement over that, but it's absolutely nothing that really registers as a real problem. It's more just a curiosity, to be honest. But the point is that I've been hearing about it for a decade, and that is a feature, not a bug, of bugs. They happen in slow motion. You have a tremendous amount of warning whenever there's going to be some problem with insects, whether it is, like northern Vermont, last few years anyway, has gotten hammered really bad with the gypsy moth, and that takes a few years to really do some damage to trees. Likewise with things like the emerald ash borer. We know that ash trees are pretty much kaput in the northern United States, but it's going to take a long time for that to happen. Even with beech scale, beech bark disease has pretty much obliterated beech in northern Maine, but if you go down to New Hampshire, they still have some very nice beech trees. And that has occurred over the course of 100 years. You have plenty of warning for these things. And when you have warning, you have time to salvage, you have time to cut. Is it going to affect your returns? Yes, absolutely. Is it going to be catastrophic? No, probably not. Now, can there be times where things happen fairly quickly? Yeah, of course, that can always happen, but almost always it happens over a very long period of time, and the window for salvage can sometimes be decades. So I talked about the spruce budworm. Like I said, that started in 1970. They were still doing salvage harvests as late as 1990. So how about something that's a little bit quicker, like a fire? Certainly, a fire can come through and absolutely destroy your timber. It can come at a moment's notice. In fact, coming up to this area to film, we were actually riding through an area that was very recently burned. And yeah, the trees were a total loss. It was a pretty big fire, and it took out a pretty large chunk of area. I'd guess somewhere around maybe 1,000 acres or so. But remember, timberland has two values: bare land value and timber values. You may have lost all of your timber values, but you still have bare land value. And the thing is, these days with the current market, the bare land value is actually higher than the timber value in most cases, but we'll just say it's 50-50. So worst case scenario, you lose 50%. And all that's really doing, the worst case scenario, is your timber was totally mature and it was going to be harvested the next day. So the worst case scenario is that your rotation, that is the total age that you grew your crop trees to. So, if you were harvesting at 60 years, your rotation age is 60 years. Worst case scenario is you have doubled your rotation age. That's certainly financially impactful. I'm not going to say that it's not, but that's probably the absolute worst case scenario. And at most, you impacted your values by 50%. And depending on how long you've owned the land, if you lost all your timber, reduced to bare land value, and then sold your land, it's very possible that you're still ROI positive just from the land appreciation alone, because obviously that's been a very salient part of the market recently. Now, obviously, like I said, that's still a substantial loss, and I don't want to make light of it, but you have to put it in perspective. That is a far cry from owning shares in Lehman Brothers or maybe owning a 1922 German bond. And of course, it shouldn't be forgotten that unlike owning shares in a company or investing in an entire nation, you have a lot of control over the risk of your forest land. You can do fuel mitigation work. You can practice proper silviculture to reduce the risk of an insect outbreak. You can do an awful lot to manage the risk you actually take on. Now, are there other risks in forestry? Yeah, of course, and we can analyze them all day and pick them apart. But the point is this: the risks in forestry are incredibly unique because you can kind of break down the values into forestry into 4 non-synchronous parts: timberland and bare land values, and then biology and economy. And those sometimes are correlated in ways, but generally they're entirely independent from each other. If biology fails, you still have economy. If economy fails, you still have biology. If the timber values fail, you still have the bare land value. If the bare land values fall, you still have the timber values. That makes it an incredibly robust asset. And this is what's so cool to me about that. So go back to those ghost trains I was talking about in the Allagash. And the landowner that owned land around those trains, I used to work for. It was actually my first job out of college. And they have owned the land for much longer than since the Great Depression. They have owned that land since, I believe, the end of the Civil War. Now, I always thought that was a cool fact when I was working for them, and I know the family is very proud of that history and heritage. But to me, there's something a lot cooler about that than meets the eye. And I didn't realize this until I actually bought my land. So when I bought my land, I spent a lot of time in the Registry of Deeds because I like to know the history of whatever land I'm working on. And I found this surveying map from the 1870s, and it had all the parcels and the landowners from the township where my land sits. And I started analyzing this map and looking at all the parcels, and I started to realize something. There was not 1, but 2 names on that map that could still be found on a 2024 tax map of that township. Now, of course, the properties had since been transferred into trusts or passed on to descendants, but the point is that there are names from 1870 that still appear on the same parcels. Now, that is absolutely wild if you consider the sheer economic volatility that has taken place during that time period. That town has seen the rise and fall of both agriculture and the railroad industry, but the forests have persisted. So when you see the persistence of ownership throughout time, and you compare that to the risks in forestry and how forests are so unique compared to other assets, you have to ask yourself if it's really a coincidence. I don't think it is. I'm going to go out on a limb and say that timberland ownership is the best method of generationally preserving wealth that is available. And it's funny because, like most commodities, forests and timber get a reputation for being a bit, we'll say, beleaguered. But I don't think reality stands up to that analysis at all. Now, it is true that if risks are more capped, so too is return. You know, in today's day and age, nobody's going to get rich off of timber. But in an age when everyone's trying to get wealthy off of the latest meme stock, I find that refreshing. At the end of the day, I can rest assured that no matter what happens to the economy, no matter what happens to the nation, or even to the entire world, my trees will keep on growing and keep doing exactly what I want them to do. And the day that stops being true, I have much more to be concerned about than my wealth. So like I said, maybe this is more of a philosophical video, but it also has a very real technical importance when you're doing financial analysis of timberland. And we'll talk more about that in the future. But for right now, just consider everything I've said here and maybe have some appreciation for that aspect of your land management. So in the meantime, if you want updates about this project and these applications, go ahead and join my newsletter. I don't really send out many emails, and of course it comes with my free ebook about forest management, but it will keep you in the loop so that when it is ready, you'll know about it and you can try it out for yourself. And also, if you're like me and you're very interested by these types of discussions and you're interested in risks and, you know, how assets have performed historically, I want to say that a lot of these ideas aren't actually mine. I have kind of adapted them to the forests, but they actually come primarily from a book by Nassim Taleb called The Black Swan. And that's really where the whole premise behind bell curves and fat tail risks comes from. So if you're interested by that, I highly recommend you pick up that book and give it a read. It's definitely worth it. It's one of my favorite books of all time. I actually should do a video someday about the great books for forestry. That would definitely be one of them. So yeah, just so you know. All right, guys, that's all for now. Thank you so much for walking. Thank you so much for watching as usual. And if you haven't subscribed already, please subscribe. There's a lot more coming your way. And of course, you're gonna wanna hear about those projects I have coming. So until next time.